Most people think they know what wealth is: a bigger salary, a larger house, a higher number on a bank screen. But history tells a far more dangerous truth. Some of the wealthiest people who ever lived, richer than entire nations, lost everything. Not slowly, overnight. And they all made the same mistake. They believed money was value. It isn't. Money is just a promise. A fragile one. And when trust breaks, when systems crack, when empires panic, that promise disappears. This isn't theory. It happened in the palaces of France, on Wall Street in 1929, in Rome, in Germany, in Japan. Every time the same pattern repeats. Those who chased wealth were wiped out. Those who built value survived. If you don't understand the difference between wealth and value, history doesn't just repeat itself. It hunts you. And today that hunt has already begun. It's so deeply rooted in our culture that most people never stop to question it. The lie is simple, that the number in your bank account is the ultimate measure of success. That as long as the figure is big enough, you've won the game. But history, both economic and personal, tells a very different story. That story is about people who had more money than entire countries, yet still ended up powerless, ruined, or completely forgotten. And it's also about others who never held vast fortunes at all, but managed to build something far more durable: value. Real value. The kind that doesn't evaporate when markets panic or currencies collapse. Once you truly understand the difference between wealth and value, you begin to see why most people are chasing the wrong prize, and why that race almost always ends in loss. So let's strip the illusion away, starting in one of the wealthiest courts in human history, France under King Louis XIV. By the early 1700s, the Sun King had transformed Versailles into the very center of European luxury. Gold-leafed walls, endless marble halls, perfectly manicured gardens stretching to the horizon. The palace itself became a monument to wealth as spectacle. Nobles spent enormous fortunes simply to keep up appearances, importing silks from China, sugar from the colonies, and wine from Bordeaux. On the surface, France appeared unimaginably rich. But beneath the glitter, the wealth was brittle. The economy depended heavily on war plunder, colonial extraction, and ever-growing debt. Taxes crushed the peasantry, while the nobility and clergy contributed almost nothing. And so, while Louis dazzled Europe with opulence, the financial foundations of the kingdom were quietly hollowing out. Fast forward to the early 1700s, when a Scottish financier named John Law rose to power as France's Controller General of Finances. His solution was radical: paper money and the Mississippi Company. At first, it felt like a miracle. Fortunes multiplied on paper. Nobles and merchants watched their wealth grow faster than they ever thought possible. But it wasn't real value. The Mississippi Company's profits were wildly inflated. Its Louisiana land was massively oversold. And when confidence collapsed in 1720, the paper wealth vanished almost overnight. Those who chased the illusion of fast money were destroyed. Those who had held on to tangible assets, land, production, practical skills, survived the storm. This was one of Europe's earliest modern lessons in the difference between apparent wealth and intrinsic value. And the pattern repeats. In the 1920s, American investors rode the stock market as if it were a one-way elevator to the top. Cars, radios, and skyscrapers symbolized unstoppable progress. Bankers and speculators leveraged themselves to dangerous extremes, creating fortunes out of thin air. Then came 1929. When the crash hit, that wealth evaporated. The survivors weren't those with the biggest portfolios, but those whose assets still had utility: farms that could grow food, factories that produced essentials, and businesses that met enduring human needs. The same lesson ignored in France was ignored again in America. Because money is not value. Money is merely a claim on value. If the underlying value disappears, the money becomes meaningless. Here's the uncomfortable truth: most of what we call wealth today is fragile. Stocks are priced on expectations of the future, not guaranteed output. Real estate values depend on interest rates and sentiment as much as bricks and mortar. Even currencies, the lifeblood of the financial system, exist only as long as people trust the institutions behind them. Lose that trust and wealth turns to dust. History shows this again and again. Weimar Germany in the 1920s, Zimbabwe in the 2000s, Venezuela in the 2010s. In every case, people who measured their lives in local currency were wiped out. Those who held hard assets or transferable skills preserved at least part of their prosperity. So if wealth is just the number, what is value? Value is the ability to produce, to endure, and to remain useful regardless of financial conditions. Value can be a skill you can trade, a network you can rely on, an asset that generates essential goods, or knowledge that solves urgent problems. Value holds when markets panic. It holds when currencies fail. It holds because people need it. And that need is the most resilient currency of all. One of the clearest examples comes from Japan's economic bubble of the 1980s. At its peak, the land beneath Tokyo's Imperial Palace was said to be worth more than all the real estate in California. Japanese corporations bought famous landmarks abroad, from Rockefeller Center to Hawaiian golf courses. On paper, Japan looked unstoppable. Then the bubble burst in 1991. Trillions in wealth vanished. Companies collapsed. Stock prices imploded. Property values fell for more than a decade. Yet Japan didn't disappear, because it still possessed something far more important: an educated workforce, a powerful manufacturing base, and a culture of precision and quality. That was value. It didn't prevent pain, but it made recovery possible. This distinction matters because the modern financial system constantly blurs the line between wealth and value, and that confusion is extremely profitable for those in power. Governments prefer citizens who measure success by account balances rather than personal resilience. Corporations prefer consumers who chase financial products instead of building durable skills or assets. The more you confuse wealth for value, the easier it is to trap you in dependency. Ancient Rome understood this instinctively. Senators owned vast estates, but their real power came from controlling essentials: grain, olive oil, wine, and shipping routes. As the denarius was slowly debased over centuries, those who held only coins lost purchasing power. Those who controlled production kept influence. The principle hasn't changed. The reason most people never achieve real financial freedom is that they chase wealth without building value. They accumulate without asking the deeper question: what actually backs this wealth? If your livelihood depends entirely on market stability, a salary, or a currency you don't control, you may not be as secure as you think. Real freedom comes when your survival doesn't rely on systems that can rewrite the rules overnight. Today, that means diversifying not just investments but forms of value. Productive assets. Essential tools. Skills that remain useful in any economy. Relationships that open doors when institutions fail. History is brutal on those who mistake appearances for substance. French aristocrats. Gilded Age tycoons. .com millionaires. All wealthy until they weren't. Because wealth without value is a castle built on sand. And that's the real opportunity. Understanding this difference isn't just academic. It's the line between those who survive economic storms and those who are swept away. The forces that destroyed Versailles, Wall Street in 1929, and Japan's bubble are still operating today, just in modern disguises. Once you see the illusion, you can't unsee it. History is filled with people who thought they were wealthy, right up until the moment they weren't. Roman merchants learned this when debasement stole purchasing power from their coins. Germans learned it pushing wheelbarrows of cash. Homeowners learned it in 2008. The lesson is timeless. The number doesn't matter if the value underneath is rotting. So ask the only question that matters: what will still hold value if the system changes? Because history doesn't repeat, but if you don't understand it, it will crush you all the same.